This is why compounding only works with a large sum of money. Most people hear that compounding rewards patience. Just start early, and time will do the rest. But time alone doesn't multiply small numbers into freedom. Waiting with too little invested is like planting one seed in barren soil. You'll get growth, but not abundance. The wealthy don't just rely on time. They feed the compounding engine with focus, skill, and capital. In this video, we'll unpack why compounding only transforms wealth when the base is large, and how the truly patient think differently. Number 1, it's about the survivability of the capital. Compounding only works when your money survives long enough to experience it. Most people talk about growth as if it's guaranteed by time, but time is irrelevant if the capital doesn't last. Small investors often take unnecessary risks chasing higher returns. They stretch too far, and when a downturn hits, their fragile base collapses. The compounding never even begins. Wealthy individuals think differently. They treat their capital as something living, something that must be protected before it can grow. They focus less on quick gains and more on resilience. In China, many long-standing family fortunes are built around a single principle known as shouben, protect the principal. Growth is secondary to survival. It's a mindset that sees preservation as the first form of profit. Think of it like a tree. Everyone admires the fruit, but the fruit only appears because the roots survived countless seasons. If the roots are damaged, the harvest ends. The wealthy build financial systems that ensure their capital can withstand economic winters. They structure their assets to survive, not impress. When you focus on survivability, you stop chasing volatility. You begin to value patience, liquidity, and understanding over excitement. You realize that in wealth, survival isn't the absence of growth, it's the foundation of it. Compounding rewards endurance, not enthusiasm. Number 2, large sums can access exclusive alternative assets. Most people think compounding is the same for everyone, that time and discipline alone will create the same result. But compounding doesn't exist in a single marketplace. Once capital reaches a certain size, the doors it opens are entirely different. Small sums live in public markets, index funds, savings accounts, and mutual funds where the returns are modest and predictable. But large sums gain entry into private equity, off-market real estate, early-stage ventures, and institutional funds, where returns compound at a higher rate, often shielded from public volatility. This is why the wealthy see money not as an end, but as access. Their capital lets them step into arenas most people never see, where opportunity itself multiplies. It's not that they're luckier, it's that scale changes the playing field. Compounding rewards magnitude. The first real advantage of large wealth is entry into a different economy altogether. Number 3, fees and taxes disproportionately erode small sums. Most people think in percentages. 1% in fees, 2% in taxes. It sounds small, almost harmless. But when the base is small, those tiny percentages act like rust. They quietly eat away at growth that's already struggling to matter. Over time, the difference isn't just numerical, it's structural. The wealthy see compounding as something fragile. It only thrives when friction is removed. That's why they structure their money through tax-efficient systems, long-term vehicles, and ownership that allows earnings to reinvest before the taxman touches them. They protect what compounds. Meanwhile, the average investor compounds after fees, after taxes, after inflation. By the time the growth shows up, most of it belongs to someone else. True compounding happens in silence, where friction is minimized and every return stays in motion. It's not just what you earn. It's what you keep multiplying. Number 4, significant capital can withstand major drawdowns. When markets fall, most people see loss. The wealthy see resilience being tested. Drawdowns are not the end of compounding. They are the price of admission. Yet for those with smaller sums, that price can feel unbearable. A 30% drop can erase years of saving, forcing them to sell just to survive. When capital is thin, patience runs out long before recovery begins. Larger capital, however, buys emotional and financial stability. It allows the investor to stay calm when others panic. Wealthy families build reserves for this reason. They expect volatility. They design for it. In Chinese financial tradition, this mindset is called patient capital, wealth that doesn't flinch. Compounding only continues when capital survives impact. That's the quiet advantage of scale. It buys endurance. Because in the long run, it's not the return that matters most, but the ability to stay invested long enough to realize it. Number 5, it provides meaningful cash flow, not just growth. Most people chase rising numbers on a screen, believing wealth is measured only by accumulation. But numbers don't feed freedom. Cash flow does. A growing account that never produces income is like a tree that looks tall but bears no fruit. You admire it, but you can't live from it. The wealthy understand that real compounding isn't just growth, it's self-sustaining motion. Their assets generate income that covers life's needs while the principal continues to expand. Dividends, rent, interest, and ownership distributions turn capital into something living, something that breathes. This is why meaningful wealth feels calm. The income it produces removes financial anxiety. The compounding continues quietly in the background while life unfolds freely in the foreground. When your money produces consistent flow, you stop chasing it. Because at that point, your wealth isn't working for growth, it's working for you. Number 6, large sums allow for true diversification. Most people think diversification means owning a few different stocks or funds, but that isn't real protection. It's just variation within the same narrow space. True diversification means spreading your wealth across different kinds of risk, across systems that behave differently when the world shifts. Small sums can't do that. When capital is limited, every decision is concentrated, often unknowingly. One downturn, one mistake, and the entire base trembles. Wealthy investors, on the other hand, can design portfolios that survive change. Businesses, property, fixed income, private equity, even cash reserves across currencies. Each piece plays a role in balance, not speculation. This kind of breadth creates calm. It means a market crash doesn't collapse your world, it merely adjusts one part of it. Diversification isn't about owning many things, it's about ensuring no single event can take everything away. Breadth protects depth. Number 7, it creates its own economic gravity. Once wealth reaches a certain size, it begins to move differently. It attracts opportunity, resources, and people in ways small capital never can. Large sums don't just sit, they shape the environment around them. Most people think money is passive, something you manage quietly in the background. But for the wealthy, capital is active. It creates introductions, invitations, and influence. They are offered better deals, earlier access, and safer terms, not because they ask for them, but because scale itself pulls value toward it. In China's family investment circles, this is understood deeply. Capital mass creates reputation, and reputation compounds into opportunity. The wealthy don't chase deals, they receive them. At that point, compounding becomes more than mathematical. Bonus principle. Focus on accumulating a critical mass first. Many people start investing early, believing time alone will do the heavy lifting. But without a meaningful base, compounding is too weak to change anything. A small seed in poor soil grows slowly, no matter how long you wait. The early stage of wealth isn't about preserving, it's about creating. The wealthy understand this. Before they think about compounding, they think about accumulation. They build businesses, increase income, and reinvest relentlessly until their capital reaches a weight that can sustain real momentum. In Chinese financial wisdom, this is the foundation phase, the period where effort matters more than returns. Once critical mass is achieved, compounding takes over naturally, like gravity pulling objects toward the earth. But until then, the focus must stay on creation, not patience. Don't try to compound too early. Build something worth compounding first. If this perspective helped you see compounding differently, write in the comments, "I'm building my base." It's a quiet reminder that clarity always comes before growth. If you found this conversation meaningful, like this video so others who seek calm, understanding, not hype, can find it too. Subscribe if you want more lessons that teach through wisdom, not noise. And share this with someone who's ready to stop chasing returns and start building resilience. In our next video, we'll explore why the wealthy never chase returns. They design environments where returns become inevitable. Thank you for spending this time in thought. May your understanding grow faster than your impatience, and may your compounding begin only when your foundation is ready.